A. Sarul Kumar, lecturer, Management Wing, Financial Management. Dear students, we are going to some of the introduction part about the financial management. First, we will see what is meant by finance. Finance, there is no proper meaning for finance. So, the meaning of finance will vary from one individual to another individual, 1 year to another year, and one country to another country. But the popular meaning of finance is cash. First popular meaning of finance is cash. Second popular meaning of finance is raising of funds. Third popular meaning of finance is raising and utilization of funds. Now we are going to see what is the meaning of management. The management is nothing but planning and controlling of everything. So the financial management is planning of and controlling of cash, planning and controlling of utilization of fund, planning and controlling of raising of funds. Now we are going to see one definition of the financial management. The financial management is concerned with efficient use of important economic resource, namely capital fund. From the definitions, we are able to analyze the capital fund of the business will be controlled efficiently. Otherwise, you are not able to run the business effectively. Now we are going to see how the financial management will interlink with other departments. First, we will see how the financial management is interlinked with the human resource department. Now, the main responsibility of the human resource department is recruiting, selecting, and training. For recruiting, selecting, and training, we need cash. Without cash, we are not able to recruit, select, and give training to the employees. So, without consultation with the financial manager, the personal manager will not able to take decisions. So the finance is very needful for each and every activities of the business. Second, we are going to see how the finance department is interlinked with the marketing department. Sole responsibility of the marketing department is fixing price. So we are going to fix the proper price for the product. If you are not fixing the proper price, means the sale of the product in the market will fail. If sale is failed in the market, means automatically your profit of the company is low. Sole responsibility of the marketing department is to fix the price. So without consultation with the financial department, marketing manager will not be take decisions independently. How the financial department is interlinked with the production department. The prime responsibility of a production manager is controlling men, materials, and machinery. First, if you are controlling men, means you are able to control the cost of the product. Second, controlling the materials. Controlling the material means you are going to utilize optimum level of materials to the production process. If you are controlling, means your cost of product is reduced. If cost of product is reduced, means automatically the selling price of the product is reduced. If selling prices of the product is reduced, automatically the people in the market started to buy the product. If sales is more, profit is more. Second, we are going to see how we are controlling machineries. If you are controlling machinery, means a good quality of output is delivered from the machinery. If you are delivering good quality of output, means the people in the market automatically start purchasing your product. It leads to increase the sales. If sales is increased, automatically the profit of the company is increased. Now, the finance is also known as a lifeblood of the business. From the above three situations, we are able to analyze how the finance is interlinked with the other department, how the finance is acting as a lifeblood of the business. Now we are going to see the some of the functions of the financial management. The first functions of the financial management is investment decisions. In investment decisions, the financial manager has to concentrate about two things. First thing is short-term investment decisions and long-term investment decisions. In short-term investment decisions, the financial manager is going to concentrate only on working capital of a particular company. In long-term investment decisions, the financial manager is going to concentrate on capital budgeting decisions. Now we are going to see what is meant by working capital and what is meant by capital budgeting decisions. First, capital budgeting decisions. The meaning of capital budgeting is decision making process on capital expenditure. Now we are going to see what is meant by capital expenditure. If you are spending an expenditure, means you are not able to enjoy the benefits immediately. You are able to enjoy the benefit after some time. That is the meaning of capital expenditure. Now I am going to give an example of capital expenditure. Take for an example, construction of a cinema theatre. For constructing a cinema theatre, how much amount is required? Take for an example, it will take 1 crore rupee. If you are spending a crore rupee for construction of a cinema theatre means the returns which is come from cinema theatre will be not enjoyed immediately, it will be enjoyed after some time. That is the first example for the capital expenditure. The second example of the capital expenditure is as far as business point of view, importing some advanced high-tech machinery from foreign countries. For importing high-tech machinery from foreign countries, it will take nearly a crore rupee or 15 crores or 30 crores rupee. If you are spending a crores of rupee for purchase of high technology machine from the foreign country means any income, any amount which is come from use of machinery will not be enjoyed immediately, it will be enjoyed after some. This is the next example of the capital expenditure. So by way of implementing capital budgeting techniques, we are able to judge whether the capital expenditure is worth or not. Once decisions taken wrongly means it is impossible for rectifying it. So before investing a capital expenditure, you are going to evaluate that capital expenditure by way of capital budgeting techniques. Now we are going to see at what time the capital budgeting technique is useful for a particular company. First, at time of expansion of the business. Second, at time of modernization of the business. Third, at time of establishing the business. At this point of time, a capital budgeting technique is very useful for a particular company. First, we will see how capital budgeting is very useful for a company at expansion of the business. If you are going to expand the business means there is a more amount of materials, machineries is required for expanding the output of the business. At the time of expansion of the business, the more amount of materials, more amount of labors, more amount of machineries needed for expanding the output of the company. Take for an example, if you are expanding output means you are going to import some high technology machine from the foreign country. For importing high technology machines for expanding the business capacity means it will take nearly a crores of rupees or more than a crores of rupees for importing high technology machine from the foreign countries. This is the second. At the time of modernization of the business, take for an example, if a company is mostly producing goods by manual labor, if they are going to convert manual into machinery means at the time the high technology machines is to be imported from the foreign countries. So at the time the capital budgeting technique is very useful for the company. Third, at the time of establishing business, at the time of establishing business you have to purchase land, you have to construct premises, you have to establishment, you have to make proper arrangements for delivering the output of the product. At this point of time the capital budgeting technique is very useful for the company. Now, at what time we are going to evaluate the investment proposals? A lot of technique is available for evaluating the investment proposals. First technique is evaluating investment proposal by a payback period method. Second method is net present value method. Third method is internal rate of return method. Fourth method is accounting rate of return. A lot of the technique is available, but among these techniques, the payback period method and the net present value method are the important methods is available for evaluating the investment proposals. Second, we are going to discuss what is meant by short-term investment decisions. The other name of short-term investment decision is working capital decisions. What is meant by working capital? The working capital is nothing but the amount is needed for running the day-to-day activities of the business. Without amount, you are not able to run the business effectively. Now I am going to give an example for importance of an working capital. How working capital is important for a particular business activity. Take for an example, in case of jewelry business, X is going to jewelry shop for purchasing 10 sovereigns of gold. What is the cost of 10 sovereigns of gold? It may take around 50,000 rupees. How much of advance is made by Mr. X? It will be depend upon the individuals. Take for an example, Mr. X is giving an advance of rupees 25,000. So the remaining 25,000 is to be paid by jewelry shop owners. For same case, if 10 customers coming per day means 2,50,000 is needed for a jewelry shop owner to run the business effectively. Without 2,50,000 per day, that jewelry shop owner will not be able to run the business effectively. This is the importance of working capital. Now, how working capital is identified for a business? If you are deducting current assets with current liability, you are able to get an working capital. What is meant by current assets? What is current assets? An assets which can be easily converted into cash within a short period of time, that is known as current assets. What is meant by current liability? And liability which is to be cleared by the business within a short period of time. The short period refers a year or less than a year. If you are deducting current assets means current liabilities, you are able to get the working capital. Example of current asset is cash, debtors, bills, receivables, inventories, etc. etc. Example of liability is bank overdraft, bills payable, sundry creditors, etc. etc. These are some of the example of the current assets and current liability. So capital budgeting decisions and working capital decisions is the first function of the financial manager. Now we are going to see the second functions of the financial manager. Second function is the financing decisions. The financing decision is nothing but the management of capital structure of the firm. Now we are going to see what is the meaning of capital. The meaning of capital will differ in case of public limited company and in case of private limited company. Now we are going to see the meaning of capital in case of private limited companies, the amount which is introduced by the proprietor. The meaning of capital in case of public limited company, amount is introduced by the business by way of issuing shares. From the above information, we can easily judge the private limited company is not able to issue shares to the public. If any private limited company issued shares to the public means automatically that the private limited company is converted into public limited company. There are two kinds of shares, equity shares and preference shares. So these equity shares and preference shares is known as a backbone of the company. These two items are playing a dominant role in framing the capital structure of the company. In addition to the equity share capital and preference share capital, a debenture is also framing a dominant role in the capital structure of the company. Equity shares, preference shares and debentures. Now we are going to see what is meant by debentures. Debenture is nothing but a bond which is to be issued to the public and accepting the deposit at agreed rate of interest. If this is entirely different from the share capital. So equity shares, preference shares and debentures are playing a dominant role in the capital structure of the company. In financing decisions, the company has to frame a combination between the debt and equity of the company. Now we are going to see the third functions of the financial management. Third function is dividend decisions. What is the meaning of dividend? The profit of the company is distributed to the shareholders. The company has to frame an appropriate strategies for paying dividend to the shareholders. If companies pays more dividend means that companies are not able to manage that company's resources. If companies paying less dividend means nobody in the share market is coming to purchase the shares of the company. So the optimum combinations between the debt and equity can be taken place in the dividend decisions. Fourth functions of the financial manager is managing the debtors and managing the creditors. Who is a debtor and who is a creditors? The debtor is a person who are enjoying the credit period of the company. Who is a creditor? Creditor is a person as giving money to the business. So these are the two important fellows giving a challenging role to the financial manager. If financial managers are not able to control the debtors and creditors means that lead to business failure. Now we are going to see what is the importance of debtors. I am going to give an example of debtors and creditors with the help of an example. Suppose X limited company is going to manufacture articles. For manufacturing articles, they need raw materials. Take for an example, the X limited company is purchasing raw materials from A and company on credit. That raw material is converted into finished goods. That finished goods is sold to the B limited company on credit. A limited company is a creditor to the business and a B limited company is a debtors to the business. If the financial managers are not able to control debtors and creditors means that leads to business failure. If debtors is not properly managed means that leads to bad debts. Now what is meant by bad debts? The bad debts is nothing but an amount which are not recovered from the debtors is known as bad debts. It's an unrecovered amount from the debtors. If more amount of bad debts is accumulated in the business means that leads to a business failure. So the management of debtors and management of creditors is also a challenging roles to the financial manager. So investment decisions, financing decisions, dividend decisions and managing debtors and creditors is the managerial functions of the financial manager. Now we are going to see what are the routine functions of the financial manager. So first routine function of the financial manager is coordination between the various departmental heads. Second routine function is a relationship between the financial institutions. So the financial manager has to make a good relationship between the banks and financial institutions for getting funds. Third routine function is a preparation of a balance sheet. Fourth routine function is a preparation of a fund flow statement. routine function is preparation of a cash flow statement. Sixth function of the routine function of the financial manager is management of cash. These are some of the routine function of the financial. Now we are going to see what is the objectives of the financial manager. There are two objectives of the financial manager: maximizing the profit and maximizing the wealth. Maximizing the profit is increasing the profit of the company. If a business is started only for making the profit, means that business is not able to survive for more number of periods. So the business is not started only for making the profit. Profit maximization is the first objective. Second objective is maximizing the wealth. Maximizing the wealth is nothing but maximizing the wealth of the shareholders. How the shareholder wealth is maximized? If you are giving more amount of dividend to the shareholder, means the shareholders wealth is reduced. So the objectives of financial manager is combination between the maximizing the profit and maximizing the wealth of the shareholders. Now we seen what is meant by financial manager, what are the definitions of the financial manager, what is the functions of the financial management, how the financial management is interlinked with the other departments, and what is the objectives of the financial manager. If before going to start a business, a financial manager is concentrated on these aspects, definitely the business has gained a profit.